Today, the Federal Reserve is expected to announce another interest rate hike to slow down inflation. That'll be the fifth this year. It's the third increase since June alone. This comes as prices are showing no signs of falling, except maybe gas prices. For more on what that means, let's bring in ABC News business reporter Alexis Christoforous. Alexis, good to see you again. What can we expect from the Fed today? Same thing that we've seen 4 times prior this year?
Exactly. This would be the 5th interest rate hike of the year, Phil, and we're expecting another aggressive move from the Federal Reserve. Most on the street have already baked in a 3/4 of a percentage point rise in the Fed's key short-term interest rates. Some even think we could see a full percentage point. And the story is the same for the Federal Reserve. They're wanting to get inflation under control. They're hoping to do that by slowing the U.S. economy and bringing demand down. So far, we haven't seen a lot of results because inflation remains at a high of 8.3%, the highest we've seen in 4 decades. And while gas prices have certainly come down quite a bit from where they were back in June, we still have near record high food prices, rent prices, and higher prices for just about everything else.
Yeah, I think for a lot of Americans, it's sort of a double-edged sword, or 6 of one, half dozen of the other. At this point, what will this mean for consumers already grappling with inflated prices? You and I have already talked about eggs up 40% or something like that.
That's right. Yeah, so what this means is borrowing costs are going to continue to get more expensive, and that's what the Fed's trying to do. They don't want us out there spending as much. So as a result, you're going to see interest rates on credit cards, auto loans, home equity loans rise. Same for small business loans and mortgage rates, which we know have been rising all year. They are now above 6% for the first time since 2008, which means you have less purchasing power if you want to buy a home. So here's a real-life example. If you took out a home loan for $320,000 at the beginning of the year, when interest rates on a 30-year fixed loan were about 3%, your monthly bill would be $1,349. At today's prevailing interest rate at just over 6%, your monthly mortgage payment jumps to $1,943, nearly $600 more per month for the same house, Phil. And where you really want to watch out is if you are carrying a balance on your credit card, because that's when things really start to add up. So if you're carrying a $5,000 balance, making minimum payments, which most Americans unfortunately do, you're already paying an additional $870 in interest because of rising rates this year. After today's hike, those interest rate payments rise to more than $1,100. So the most prudent thing you can do in an environment of rising interest rates is make priority number 1 paying down your debt.
Indeed, because it's only going to grow from here. Alexis Christoforous, thank you so much. Do appreciate it.
Hi, everyone. George Stephanopoulos here. Thanks for checking out the ABC News YouTube channel. If you'd like to get more videos, show highlights, and watch live event coverage, click on the right over here to subscribe to our channel. And don't forget to download the ABC News app for breaking news alerts. Thanks for watching.